Welcome to What School Should Have Taught You, a podcast where I share with you all the lessons you need to know about wealth creation and answering your questions along the way too. Click the link below and send in your questions, and we could be getting you on this show to have a chat about what things we could help you set you on the right path for your wealth creation journey.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Let's have a chat today about tax deductions and mindset. Now, in my experience as an accountant, and it's a topic and a scenario of questions that I speak about every day with many of my clients, and it's really getting people on the right playing field about what a tax deduction is, how it works, and how to best to capture it with inside your return and how to best benefit from it in the future. We've got to start with the basics. What is a tax deduction? And a tax deduction, quite simply, is an expense that you've incurred in relation to earning your income. And it's so important to make sure that, yes, you are keeping all the proper documentation that you require at the end of tax time, but there's a number of other elements that you need to make sure that you're ticking off when knowing when to spend or not spend that money in relation to a cost that you need to incur for work purposes. And we're going to talk about nexus being the first one. Nexus is important. There needs to be a connection between the expense that you're paying and the job that you're doing. Now, a great example of the right nexus is, as an accountant, I have to purchase a calculator to assist in the numbers and me preparing the numbers for my clients. I'd love to say that I'm a mathematician, but really I'm not. I can't multiply 7,000 times 245.76. So I do use a calculator in my daily course of activities. An example where nexus is not involved in my job is I purchase a hat. I need to put a hat on to go outside to collect my lunch. Although it's sun safe, and I don't disagree with getting a hat, especially in between your lunch journeys, but nevertheless, it's not required for me to perform my activities at work. Another great area I like to chat with people is about timing of deductions. Now, again, if you're spending your money on the 2nd of July of 2023, you're not really going to get the benefit of that expense in your tax return until your return is lodged, which is sometime after 30 June 2024. So it's important that if you can hold off spending that particular amount of money, that you have the connection between your work and your employment. It might be worthwhile to try to spend that money as late as you possibly can, so that way the money that's coming back to you in terms of a refund or in terms of a tax benefit if you're running an organization comes back to you sooner rather than later. So your money is really not invested in someone else's business, and it's coming back to you much quicker in terms of the ATO relief. Another thing that I'd like to discuss about is depreciation versus immediate tax deduction. Now, this is something that it's a pain point for many people, but Jeremy, I've spent that money today. Why am I getting a tax deduction over the next 3 to 5 years? And this is more important for businesses. Yes, sometimes it's applicable to employees, but also very common for property investors as well. You need to understand that your expense, the cost that you've paid, may have a useful life. And if that useful life is over a certain amount of time, let's say for argument's sake 5 years, then that expense, the tax benefit attached to that expense comes to you over 5 years, as opposed to an immediate write-off or an immediate deduction where the whole dollar of that expense comes back to you as a marginal tax relief rate. It's really important to have a chat with your professionals about what is depreciated and what is an immediate tax benefit. And again, if you can have that coming in conjunction with the timing of the expense, then that could come back to you as a really good relief with inside your return, or again, as a benefit that you might receive if you're a corporate entity. Another big thing is the marginal tax rate. Now, this is a conversation I have all the time. Jeremy, I've spent the dollar, why aren't I getting my dollar back? In the tax system that we are in Australia, it's called the marginal tax rate system. And what that means is as we start to earn more money, we are taxed at a certain percentage. So roughly between $0 and $18,400, the tax rate's $0. So if you are spending money on your job, you will not receive any tax benefit because you're not paying any tax to start with. If your income is between $18,400 to say 45 grand, the tax rate is about 19 cents in the dollar plus Medicare levy, which is about 2% of your taxable income. So again, in this particular case, you would only receive roughly about 21% in the dollar back from the expense that you've incurred that is not depreciated, but an immediate deduction. And then once we earn $45,000 and above, we start to go through the higher tax rates. And that means every dollar that you do spend, you will be receiving your marginal tax rate back as a benefit, or a benefit back in a corporate entity, which could be between 25 cents and 30%, depending on the level of income and how you're classified as a small or large business. So it's so important to understand that every dollar that you spend, you're not getting your $1 back. You're getting a certain percentage back. So it's important that if you need to spend that money for work or to perform your activities, 100% you do it. If it's going to give you the ability of earning extra income, unreal. Make sure you're doing it and you're trying to time when you're doing it. But if you're spending that dollar because the person off the street or a best mate or a girlfriend mentioned to you that, hey, you're going to get some money back from tax, don't just think you're getting your whole dollar back. You're only going to get a certain percentage. So in order to continue to create wealth, your goal is very simple. Try not to spend that dollar if you can. This is one of the major topics that I do spend a lot of time with many of my clients every year. And it's, if you're getting an allowance from work, this one is for you. Now remember, an allowance is provided to you from your employer for expenses that you may incur in relation to working. So for instance, we'll take a real estate agent, for example. A real estate agent will generally get an allowance for phone and an allowance for travel. Or you might be a sales agent, again, get an allowance for phone or an allowance for travel. Now, often people say, Jeremy, I'm getting a $20,000 allowance. I need to make sure I spend that money. I don't want to get a tax bill at the end of the year. But what people need to understand is that that allowance that's been provided to you is a provision. It's a provision for expenses you may or may not occur. Now, in my way of looking at things, I look at the allowance as almost a bonus. I'm getting $20,000 to utilize on expenses, and whatever I don't utilize, I think of it as cash income. It's income that I've received, but I may not have paid tax on it. Allowances can be taxed or untaxed. It really depends on what you negotiate with your employer. Now, if it's a taxed allowance, it means that if you've received 20 grand as an allowance package, you may have already paid $6,000 tax on that, and therefore $14,000 becomes your net income for you to spend on expenses in relation to your work activities. You will get a refund based on the expenses that you incur. In some situations, and most often than not, I see the $20,000 allowance not being taxed, which means that $20,000 has been provided to you as raw income, and it's up to you to have the certain amount of expenses against that. And if there's a portion that's left over, i.e. the allowance being more than the expenses that we've received, then there will be a tax obligation at the end based on your marginal tax rate. So I encourage people to make sure that they're really only spending the money that they need to spend. Don't spend it for the sake of spending it, because again, it's only saving you 19, 32, 40, or even 40 cents in the dollar tax. I'd much rather see that income in your pocket and you spending that 30 or 40 cents dollar in the tax. And that way that allowance is coming to you almost as a bonus that you haven't provisioned for, because it's income with no expense on the other side. And you can then choose to use that income how you wish, like put into an offset account against your own home, use it for additional savings or additional investment, or you might want to spend that on yourself after the tax has been paid in your return. So don't be too worried. Very important, tax deductions. It's an expense that's incurred in relation to your earning or employment or business activities. And at the end of the day, if you haven't spent enough money to, say, cover your allowances we've just spoken about, treat it and think of it as a bonus. Get that mindset right. The income that I've earned, yes, I am paying tax on it, but that net residual balance is a balance that I now can invest and save, and therefore better my future and better my wealth creation journey. So it's important to recap on our various things. We've got what is a tax deduction, again, an expense that's incurred in relation to performing your employment or business activities. We've got the nexus of the deduction. It needs to have that connection. It needs to go towards the ability of earning additional income. We spoke about depreciation versus immediate. What has a useful life, such as in instance a car. Generally, we depreciate a car over its useful life, and it does not provide us a deduction in full. And there are some certain examples of when it can, depending on immediate tax write-off ability for small businesses. We spoke about timing of deductions, how important it is to make sure that you time your deduction so you're getting your money back from the ATO or getting a tax benefit from the ATO in a much shorter time frame. We spoke about the marginal tax rate system and you only receiving a tax benefit based upon the marginal tax rate that you're in. So it's so important you're not getting that $1 back when you're spending that dollar for work-related expenses. We also discussed you only spending the money that you need to spend, and it's an important, very important sentence. Only spending the money that you need to spend, because ideally, I want to see most of that money staying in your back pocket. Yes, there might be a small tax abatement that needs to come back to the tax office, but at least it's giving you a bit more free-flowing income to invest in other things and start your wealth creation journey a lot sooner, or speed it up if you're already in your wealth creation journey. And the most important one, we spoke about allowances. Remember, the allowance is a provision there for you to spend money if you need to. And if you can keep most of that allowance in your back pocket a bit, there might be a little bit of tax that you need to pay at the end of the year. But again, it goes back to that previous point I raised. It's needing to spend the money as opposed to wanting to spend the money. So what we've discussed is all about tax deduction mindset. Don't go out there and start spending money like crazy. Make sure there's that nexus and ensure that with any free-flowing income that you've got, if you can divert that into various different investment streams, it's going to make you very successful into the future. This is what school should have taught you. I'm Jeremy Iannuzzelli, and I hope to speak with you next week.